Zillow just updated its home price forecast, and their prediction for Kansas City might actually shock you. Nationwide, they're calling for a drop in home sales over the next 12 months. Not a crash, but a soft slide. In places like San Francisco, Austin, and parts of Florida, Zillow expects prices to fall 5 to 6%. But here in Kansas City, they're projecting a 0.7% dip. That's it. So what gives? Is KC just built different, or are we heading towards a delayed correction? Because I'm gonna be real with you, as someone who sells homes here every single day, I'm still seeing bidding wars. Inventory's tight. Buyers are picky, but the good houses, they don't last long. So while we're definitely feeling the effects of high interest rates and affordability strain, this market isn't crashing. Not even close. So in this video, we're gonna break it all down, what Zillow's forecast actually means and how we stack up nationally. Plus, we'll cover the wild cards that aren't showing up in the data yet, like the 2026 World Cup and how short-term rental laws could quietly shape demand. Because while the national headlines might have you thinking about doom and gloom, Kansas City is playing by its own rules. And the story here, it's a lot more nuanced and honestly kind of fascinating. Oh, and if you're thinking about buying, selling, or relocating to the Kansas City area, you can book a call with our team using the link down in the description. We'd love to help. So let's start with the big picture. Zillow's latest forecast says U.S. home prices are expected to drop by 1% between June 2025 and June 2026. That's not a dramatic crash, but it is a meaningful reversal, especially considering that at the beginning of the year, they were predicting prices would actually rise 2.6%. So what changed? According to Zillow, the turning point has been inventory. More sellers are coming off the sidelines, likely spooked by recession talk or hoping to cash in before prices soften even more. But here's the kicker. Buyer demand hasn't kept pace. Mortgage rates are still hovering in the 6.5% to 7% range. Affordability is stretched thin, and a lot of would-be buyers are just waiting. That gap between rising inventory and slower demand, that's what's putting downward pressure on prices in markets that were red hot just a few years ago. Zillow economists put it this way: sellers have been motivated to join the market through the first half of the year, but buyer demand hasn't kept up. With housing inventory accumulating, home values will likely decline by 2% in the calendar year of 2025. And when you zoom in on the worst hit markets, you'll notice a theme. Most of these are in the South, places like Louisiana and Texas, where pandemic-era booms have now run headfirst into affordability walls. Here are some of Zillow's top forecasted decliners over the next 12 months. Austin, Texas down 5.1%, San Francisco down 6.1%, and New Orleans down 7.2%. In contrast, Kansas City's projected decline is 0.7%, practically flat. So again, that raises a question. Why is KC holding steady when other cities are wobbling? Part of it comes down to affordability. Unlike cities like Austin or Miami, Kansas City never had a runaway price boom. Our market saw steady, healthy appreciation, but nothing that sent prices into the stratosphere. And part of it is what's not happening. We're not seeing the kind of inventory flood that other markets are grappling with. In fact, when we break down the new construction and resale data, you'll see that Kansas City still has a major supply shortage. But before we go there, just know this. Even national models like Zillow's, as helpful as they are, struggle to capture what's actually happening on the local level. And that's especially true in the Midwest. Now let's break this down to the more local level and talk about one of the biggest drivers of affordability, new construction. If you're wondering why home prices in Kansas City haven't fallen off a cliff despite high mortgage rates, this next part explains a lot. The peak for new construction permits in the Kansas City metro was actually back in 2021 when builders pulled over 6,500 permits across the region. Since then, it's been a downward slide. In 2022, total permits dropped to 4,885, a noticeable slowdown, but nothing like what came next. By 2023, the market bottomed out at just 3,947 permits pulled metro-wide. That's a nearly 40% drop from the 2021 peak. Last year, in 2024, we saw a modest recovery with 4,500 permits pulled, but we're still well below peak levels. And so far in 2025, the pace is tracking slightly above last year for single-family homes, but multifamily starts have pulled back again. This is critical context for everything else we're about to talk about, because if we're not building enough homes to meet demand, even high interest rates won't be enough to push prices down significantly. So now that we've got the supply picture, let's zoom into what's actually happening in the Kansas City market, starting with how the overall metro is performing. 2022 was a turning point. The spring market was bananas. Homes were flying off the shelf in under 2 weeks, sellers were getting over asking, and inventory was barely a month deep. But then interest rates started climbing, and the second half of the year, that's when the brakes hit. We ended 2022 with closed sales down 12%. 2023 cooled even further, with sales dropping another 15% and days on market jumped to 36. But even with that slowdown, prices held up, the median stayed flat at 300K, and supply remained tight. In 2024, things stayed mostly flat. Sales inched up by 2.3% and days on market stretched to 40. Still, prices pushed up a bit higher and the median price rose to $315,000 metro-wide and supply nudged up to 1.8 months. Now in 2025, we're seeing some signs of life. Year to date, sales are up 1.8% and homes are sitting a little longer, about 44 days on average. But again, prices are still climbing. The median is up to $325,000 and inventory is around 2.3 months, still well below the 5 to 6 months that would signal a balanced market. And here's what I'm seeing on the ground. Yes, the pace has slowed, but it's not a crash. And it really depends on where you're looking, because the average is just that, an average. We've had 2 clients lose out on homes in Overland Park in bidding wars on $500,000 listings. So while the broader numbers are flattening, there are still submarkets where things are red hot. We'll get into all that in a minute when we break down by county, because Kansas City is anything but a one-size-fits-all. Now, when we zoom in a little bit more, Kansas City really comes down to 5 or 6 distinct counties that are each behaving a little differently. Johnson County is still leading the charge on price. The median sales price here is $463,000, up 3.1% year to date, and homes are taking about 38 days to sell, a slight improvement from this time last year. What's really notable here is that closed sales are up 9.6%, which shows buyers are still active despite affordability challenges. Next up, Jackson County, which includes most of Kansas City, Missouri. Sales volume is completely flat at around 5,000 homes sold this year compared to 4,900 at this point last year, but prices are doing just fine. Median sales price is up 5.4% to $270,000, and homes are selling in about 42 days, a small increase from 2024. So yeah, stable, steady, but no fireworks. Then over in Clay County, it's holding its own. Closed sales are up 0.3%, and the median price has moved to $330,000, but that's flat year over year. Days on market is down slightly at 38, which tells me demand is still strong enough to keep things moving, even if prices are cooling off a bit. Then there's Platte County, where we're seeing a bit more of a shift. Closed sales are up 12.4%, so volume is up, but prices are flat. $390,000, and homes are sitting for much longer at 51 days on market on average, which is up 4.1% from last year. Also worth noting, inventory in June was up 22% year over year, the biggest jump of any county. And then we get to Wyandotte County, where affordability still draws in a lot of demand. Sales are up 3.2%, and the median price climbed 6.8 to $235,000, which is the biggest jump in the metro. But things are slowing down a bit. Days on market is 37, which is up 27.6% year over year. That's a big shift, and it could be a sign that supply is finally catching up with demand on the lower end. So what's the takeaway? Even though the metro-wide numbers paint a picture of balance, the truth is much more nuanced. Some counties are still red hot. Others are shifting into a more buyer-friendly zone, and in our experience on the ground, it really depends on the neighborhood, price point, and how well the home is prepped for the market. So, is a housing crash coming? Based on everything we just walked through, my answer is no. We're not seeing anything close to a crash here in Kansas City. No sudden wave of inventory, no major price declines, no spike in distressed sellers. If anything, we're watching the market normalize after a wild few years. But and this is important, we are seeing signs of softening. Not falling off a cliff, but gradually cooling. Sales are still below their pre-pandemic highs. Days on market is creeping up. Inventory is increasing slowly, and bidding wars, they're still happening in certain pockets, especially in that $400,000 to $600,000 range in Overland Park and parts of Johnson County. But they're no longer the norm. Buyers have more leverage now than they've had in years, but that doesn't mean they're in the driver's seat everywhere, and they're no longer fighting over every listing. And if rates come down, we might see things heat up again in a hurry, but for now, it's a more balanced playing field. And that balance, it's actually a good thing. We don't want 20 offers on every home. We don't want people waiving inspections just to win. A stable market with moderate price growth and steady stream of inventory, that's the sweet spot. And right now, Kansas City is inching closer to it. So while the national headlines might talk about corrections and downturns, here in KC, the story is more boring, and that's a good thing. But here are a couple of wild cards we should talk about. Even in a relatively steady market like Kansas City, there are always a few variables lurking in the background, things that don't show up in the chart but can absolutely move the needle. First up, interest rates. If rates drop to the mid-5s or lower, you can expect more buyers to re-enter the market and quickly. Demand would spike, inventory would tighten up again, and prices could start climbing faster than expected. But if rates stay stuck where they are, or worse, tick back up, then we're probably in for more of the same. Slower volume, longer days on market, and a continued tug of war between buyers and sellers. Then there's the short-term rental situation. Kansas City already cracked down on short-term rentals like Airbnb and Vrbo's, passing new rules that banned non-owner occupied rentals in most residential neighborhoods. That alone was a major shift, but here's where it gets interesting. There's been some talk of relaxing those restrictions during the World Cup to accommodate the influx of visitors. If that happens, it could encourage some property owners to hold on to homes they might have sold otherwise, hoping to cash in during the tournament. It's a bit of a wild card, especially since short-term rentals are one of the few levers the city can pull to boost lodging capacity quickly. And then, of course, there's the World Cup itself. We're a year out from Kansas City hosting the biggest sporting event on the planet. That alone is a huge deal. But beyond the short-term spike in tourism and economic activity, there's a bigger question. What happens after the games are over? If the city shows well on the global stage, if people leave thinking, KC's actually kind of awesome, that could pay dividends for years. More out-of-town investors, more corporate attention, more relocations from pricier markets. So no, this market isn't crashing, but between interest rates, short-term rental policies, and the massive spotlight that's coming our way, we're entering a stretch where a lot could change very quickly. So if you've been scrolling the headlines waiting for the Kansas City housing market to crash, you might be waiting quite a while. The numbers just don't back it up. We've got higher days on market, sure, and sales volumes are still well below the 2021 frenzy, but prices, they've held steady and even ticked up in most counties. Inventory is still tight, and new construction nowhere near the levels needed to close the gap anytime soon. Yes, the market is softer than it was, but softer doesn't mean broken. It means buyers finally have a bit more leverage and sellers have to price more realistically. That's not a crash. That's a correction, a rebalancing. And in the grand scheme, it's probably healthy. If you're a buyer, this is the moment to shop smart. You might not have to fight off 10 offers, but good homes are still moving quickly, especially in hot pockets like Overland Park and Brookside. So be ready. If you're a seller, strategy matters more than ever. List at the right price, prep the home well, and work with someone who understands what today's buyers care about. And if you're just watching from the sidelines wondering where all this goes next, remember that real estate is always hyper local. What's happening in Austin or Miami or Denver doesn't necessarily translate here. We're not crashing, we're just shifting, slowly, carefully, and in many cases, resiliently. If you're considering buying or selling anywhere in the metro, we'd love to help you navigate the shifting market. Shoot me an email at info@movingtokc.net or book a call using the link in the description below. And if you want to know what suburbs are the hottest right now, watch this next video here. Thanks for watching, and we'll see you on the next one.